Well, hello again, everyone. Every time I listen to our fearless analyst and director of research, my confidence in how the world is going to work grows. And, listening to our inspiring guests, David Liu, who you just heard, talk about curing disease and having us control our genetic destiny, that's pretty amazing. The tone changes that I hear from people like David and Peter Diamandis about space, and then reflecting on Raoul Paul about blockchain. Just innovation is evolving so quickly. We have to just listen and look at the tone changes that take place from one conversation to the next to understand how rapidly the world is going to change.
Welcome to Investing Wise Academy, a channel where aspiring millionaires and billionaires can learn how to invest wisely. In this video, we're going to listen to Cathie Wood's statement on embracing volatility. If you're new to our channel, please subscribe to see more videos like this. Let's get started. Raoul made a statement that Cathie Wood's thought was critical, and it does address a major issue. The public equity markets have been disseminated in the last year, and this is well known. It's been approximately a year since it was ravaged, and Raoul mentioned that when there's a change in the expectations, it can be repaired. There was a belief that the economy would open up, interest rates would rise, and inflation would rise last year, but there was a shift this year. Fear of rising inflation and interest rates has engulfed the market, and they haven't gone away. At first, the innovation space was seized in a confusing way by the phenomenon. I'll state now that the 2-year treasury and the market itself have priced in the last 4 interest rate rises, so it's not a new phenomenon. The stock market is pricing this probability too heavily, according to Cathie Wood.
And if anything, oil prices going up are an incredibly burdensome tax on the lowest socioeconomic demographic sectors in our economy. So I think the fears here are going to shift from rising interest rates and higher inflation potentially to recession, especially, and you've heard me on this before, because we see inventories piling up throughout the ecosystem. So innovation stocks in the public equity markets are down, I'm going to say broadly, 50 to 75% in the last year. I mean, that's as bad as it got during 08-09.
Based on Cathie Wood's statement, we're witnessing numerous examples of price increase in the private marketplace during the past year. There have been 50% to 100% increase in private markets, and I believe they have it. Because of what you learn about studies today, the private markets, they're more correct in terms of what they should be discounting right now, like how profound the changes are, how exponential the development will be, and how the equity market cap is going to soar in certain areas. There has also been a double whammy in the public equity markets, which I believe helps explain what's going on in the financial markets. Reverting to your benchmarks, which are all short on innovations, is what many traditional asset managers mean when they say they're going risk-off. They're mostly focusing on the mega-cap tech stocks for their inventiveness. Many indecisive and portfolios in the traditional asset management market now have a disproportionate amount of weight given to them. The 0.809 crash and subsequent ID and telecom busts have accelerated this trend toward benchmark-style investing over the past 2 decades. The market's fear of risk is obvious. Traditional research is starting to pay more attention to benchmarks. Not only the portfolio managers, but also their analysts have become very focused on the short term. There are other ways to describe traditional research, and ARK has tried to take advantage of inefficiencies in the market to make money off of them. Analysts' work in the traditional world of asset management is most likely broken up by sector, industry, or sub-industry. Their work is very specialized, very narrow, and short-term. They can't perceive the convergences between among the 14 technologies we discussed today as clearly as we can due to the siluization. So the study in ARK is benchmark agnostic and long-term in its time range. Its investing time horizon is 5 years. Because of this, ARK's analyst roles are structured to facilitate collaboration and exploration of the convergences between and among different technologies.
Their responsibilities are set up by technology, very, very different. from the traditional asset management world, because we believe each of these technologies is going to cut across economic sectors. So they are specialists and they are domain experts in these technologies, and they're generalists when it comes to sectors, because these technologies are going to fall in price, and therefore access will open up to many more sectors, in many ways going mass market.
Wright's Law is at the center of ARC's research. This is something else you don't see in the traditional world of asset management. To really take advantage of an opportunity, you have to know how quickly costs will go down and what the price will be. Find out the extremely valuable elasticity of demand. Cathie Wood says that innovation solves problems, and you probably heard about a lot of innovation that will solve problems. We saw it with COVID the year before. In the last 2 years, problems have been solved by new ideas. We have tests and vaccines that no one thought would get in such a short time. Now we have supply chain issues. We have labor shortages. We have cost of capital going up, and we have automation of all kinds, and we have D5. Cathie thinks that the new idea they are searching are a great addition to the traditional asset management focused portfolios. If they are right, there will be a lot of creative destruction in the traditional world order, which is shown by more traditional benchmarks.
And if that is right, then a hedge with innovation strategies is not only appropriate, but we think will be necessary. And I do want to talk a little bit about volatility here. Volatility has become the watchword, and as Brett said in his opening remarks, many people associate volatility with risk. Volatility is more associated with uncertainty, and when time horizons collapse, as they have within the last year, then the volatility does increase. We use volatility to our advantage. We concentrate towards our highest conviction names, and that tends to work out very well as we go through these corrections. I will say, as we go through these corrections, and in terms of the way we are being covered in the market.
Cathie says there are some bad situations where journalists use endpoint sensitivities, and they are kind of random. The time period that these journalists use are really not fair, but I guess I'll end this section by saying that inflation and interest rates risk seem to be priced in when you had a correction like this and the rest of the market has followed suit. Cathie believes that innovation is on sale, and it will be really important for investors to get to move toward the right side of change given the amount of disruption that we expect.
And that I hope our research today telegraphed to you. It's also very important to keep that 5-year investment time horizon. The difference between linear growth and exponential growth when you're talking about a 5-year period is enormous. And because Wright's Law gets us to, I think, to the right answer in terms of the exponential growth trajectories, the surprises are going to be enormous. And most important, we like to say, as we're focusing on the 5 years, keep your eye on the prize. We realize it's been a very difficult market. We also do believe, and our conviction this past year actually has increased, that these exponential growth trajectories have been accelerated by COVID, and even more so now by the turmoil we're seeing in the labor markets, logistics, and in the financial markets.
That's all for today. What are your thoughts on Cathie Wood's advice? Join the conversation in the comment section below. Please click the like and subscribe buttons if you enjoyed the video. We'll see you in the next one.